Welcome to week 2, Money and Banking and Financial Markets, University of Buckingham, summer term, July to September 2020. Again, just a reminder that despite the online teaching, all the student services and experience are still here for you: Students' Union, Career Service, Student Conduct and Student First. We have on this slide email and social media addresses and some phone numbers, so please use them if you need to. This week we're going to talk about interest rates. Lecture 2, week 2. Contents of the lecture: you can read Michigan chapters 4, 5 and 6. First, we're going to consider what actually are interest rates. We'll then look at the behaviour of the interest rates and then look at the risk and term structure of interest rates. Well, first, what are interest rates? Before we can go on with any study of money, banking and financial markets, interest rates are extremely important. We must know exactly what the phrase interest rate refers to and actually means. So initially we're going to look at the concept known as the yield to maturity, which is the most accurate measure of an interest rate, which you might call, another way of looking at it is a rental rate on borrowing money. What you will learn is to be able to calculate the present value of future cash flows and the yield to maturity on 4 different types of credit market instruments, which of course are, in the broader sense, forms of money. Recognize the distinctions among yield to maturity, be able to distinguish this from current yield, the rate of return on an asset, and the rate of capital gain, and understand the distinction between real and nominal interest rates. Well, as I mentioned, an interest rate is basically just a rental rate on borrowing money. And the fundamental concept is that of present value. A dollar, a pound, or any currency paid to you 1 year from now is less valuable than a dollar or any other currency pound paid to you today, for a number of reasons. The first reason is obviously people have their own time preference for money. If your consumption needs are high, a pound today or a dollar today is worth more to you than a dollar to be received in a year's time. But if also you don't have any pressing consumption needs, and you actually, we said that money can be a store of value. If you don't need pressing consumption needs, then you may be willing to actually lend out your money and then receive a rental payment for that. In other words, somebody will be willing to pay interest. So a dollar today, deposited today, can earn some rate of interest and become larger in a year from today. So very, very simply, if I is the rate of interest for 1 year, then a dollar today is worth $1 multiplied by 1 plus the rate of interest. So if the rate of interest was 10%, a dollar today is worth $1, 10 cents in a year's time. So the idea of the present value is what is the present value of a dollar received in a year's time. And because of the ability to earn interest and for that dollar to grow, the present value of a dollar paid in a year's time will always be less than a dollar received today. Let's look at how you can calculate present value. Well, if the rate of interest is 10%, in other words 0.1, in 1 year, $100 would be worth $110. In other words, x 100 x into 1 plus 0.1. So another way of looking at it is that if we want to know what the present value of a dollar received in $100 received in a year's time will be, and compare that with the present value of $100. Well, the present, obviously, if you invest that money, you will receive $110 in a year's time. So that is effectively higher than the present value of actually receiving $100 in a year's time, because you can actually rent it out on a rate of interest. Another way of looking at it is that the $110 is the future value of $100 invested today. Now in 2 years' time, this obviously it grows, so it becomes $121, or it's $100 into 1 plus 0.1 squared. In 3 years' time becomes $133, or it's 1 plus the rate of interest cubed. And then finally, in n years, so in any particular number of years, it's going to be $100 multiplied by x, and x is of course 1 plus the rate of interest raised to the power of n. A simple measure of present value then, if present value is today's present value, CF is a future cash flow payment you expect in some time in the future, I is the rate of interest, then depend upon how many periods you want to look at, the present value will be the cash flow you receive in say n years, and divided by 1 plus I raised to the power of n. So 1 over 1 plus I raised to the power of n is like a discount factor. The future value has to be discounted to get to the present value. Simple present value, you can't directly compare payment schedule in different points in the timeline. For example, you might have a tire line with 100 year 0, $100 year 1, and so on up to year n. Here's the present value. We actually have 4 types of credit market instruments that we can work out the present values for. A very simple loan, a fixed payment loan, a coupon bond, and a discount bond. Now we need to know what the yield to maturity is. The yield to maturity is the interest rate that equates the present value of the cash flow payments received from a debt instrument with its value today. So in other words, we have the cash flow received in the future, we have the present value of that cash flow, and the yield to maturity is the interest rate which will actually equate the present value with its value today. Let's look at how to calculate the yield to maturity in a simple loan. Let's say that the present value of the amount borrowed is $100. The cash flow after 1 year, you receive $110. In this case, the number of years is just simply 1. So the present value is $100. $100 then is the present value of receiving $110 in the future. in this case in 1 year. So if we have the present value and the money we'll receive in the future, and we want to know what yield to maturity uh, that is actually giving us, in other words, what interest rate equates the present value with the value of the money we receive in the future because of that interest rate, then we can simply calculate the interest rate of a simple loan. So we put $100 we know is the present value, $110 is the future value, what we'd expect to get at the end of a year, and this is obviously discounted by the factor 1 over 1 plus I, in this case raised to the power 1 because it's only 1 year. Multiply both sides by 1 over 1 plus I raised to the power 1, and then divide by $100, so it's 110 over $100. We can then quite easily solve for I, and then I, it gives you the rate of interest, or the yield to maturity on a simple loan is then just simply 10%. So for simple loans, the simple interest rate, the rental on value received on money, the rental rate received on money is equal to the yield to maturity. Now let's look at a fixed payment loan. In a fixed payment loan, the same cash flow payment is received through every period throughout the life of the loan. So let's say LV is the loan value, how much we've actually lent out or borrowed, depending upon from which perspective we are. Let's see, FP is the fixed yearly payment, N is the number of years to maturity, then simply the loan value is simply the fixed yearly payment for each year discounted by the yield, the interest rate that we're expected on, which is in this case expected to be constant, added up every year until the end of the loan. So if the loan was for 5 years, that would be 1 plus I raised to the power of 5. So we see that the loan value, the present value of that loan, is going to be the sum of the fixed yearly payment received every year discounted by how many years it's received in the future. Again, because the present value, that a dollar today is worth more than a dollar received in the future. So to be able to give up a dollar received today for money in the future, you need more money to compensate you, and the yield is the rental rate of lending money, or the rental rate you have to pay if you borrow money. So let's look at a very, very common and very, very useful financial instrument, which is a coupon bond. Now, a coupon bond can either be a corporate bond, a municipal bond issued by a local authority, or a bond issued by a central government. Now, coupon bonds can be traded on the market. Usually, prices are on dealer screens, unlike the prices of share prices, which are transparent and opaque. But obviously, the price of a coupon bond is related to what is the present value now of the stream of income and capital value which the coupon bond provides. Let's say it's a company like Tesla, the electric vehicle company. It might want to borrow 10 million. It might issue a tradable bond, which it borrows 10 million, promises to pay 10% as a coupon. So it would pay that 10% every 6 months. So to make it simple, let's just say every year. So the holder of the bond will receive for the years of the bond, 10% of the 10 million, and finally at the end of the bond, when the bond matures, say in 10 years, they will receive the face value back. Now, because of the fact that a dollar or a pound now is worth more than a dollar or a pound in the future, it's necessary to discount those coupon payments, or and then eventually the face value payment when the bond matures. Now, obviously, the longer to maturity, the less is the value of the face value if you're holding a bond. But the value of the coupon payments are calculated just by a kind of regular discount factor. So, what are the discount factors? Well, if P is the price of the coupon bond, in other words, the present value now of the stream of income, in other words, it's what would you be prepared to pay to receive that. C is the yearly coupon payment. In other words, it's what you get, the same amount every year based upon the face value of the bond. And F is the face value of the bond itself, which you get repaid on maturity. And N is the years to maturity. Now, if it was just a simple 1 year bond, it would just simply be P equals C plus I, discount by 1 over I, plus the face value, again discounted by the same factor, 1 over I. So we need to know what the present value of the stream is. We would need to know the value of I, or if we have a value of I, then we would be able to find what the present value of that stream of income is actually worth to the holder of the bond. And the present value of that stream of income is effectively the price of the bond now, which may actually differ from on initial issue. And the longer the maturity, the more the price of the bond could vary because of trading of the bond itself. Its face value, that's very, very simple. The yield to maturity is exactly the same to the coupon rate. So if the price of a bond, if the bond has a face value of $1,000, the yield to maturity will be 10% if it's exactly the same, if the price is the same as the face value. So in that case, the yield to maturity and the coupon rate are the same. But for different prices of the bond, the yield to maturity and the coupon rate will differ, because obviously you may be paying more for a bond, which actually gives you a face value of more than $1,000. So what is the present value of that stream? Or you may be paying less for a bond, which gives you $1,000 at face value. So again, what is the price for that? That price would obviously be lower, because you're actually getting, if you're paying less than face value, you are getting, in terms of a yield, you're getting the present value of the stream of coupon payments plus the present value of the face value on maturity, which you get. But you've also received a discount. You actually bought a bond which will give you a face value of $1,000 in so many years' time for less than $1,000. So the price of a coupon bond and the yield to maturity will therefore be negatively related. The present value of the stream of income, will actually fall as the yield to maturity rises. Similarly, if the yield to maturity falls, the price or the present value of that stream of income will actually be higher than the face value. So the yield to maturity is greater than the coupon rate when the bond price, as I've just said, is below its face value, or it is actually lower if the bond price is above its face value. In the initial equation, the coupon payment, the face value, the years to maturity, and the price of the bond were known quantities. But the yield to maturity was not, and that can differ, as we've seen, from the coupon. And when making a decision to buy a bond, it must be compared with current interest rates, so the cost, which is the cost of renting money. So if you're making a decision to buy a bond, the price of that bond will be related to the yield to maturity, as we've said, negatively related. The equation can be solved for the yield to maturity, which obviously depends upon the price of the bond, which you pay for, compared to the face value that you actually get on maturity and the coupon rate. Most financial calculators have built-in programs that solve the equation for you, or if you want to play around in an Excel sheet, you can set up a formula to do it. And here's an example. Let's find the yield to maturity of a given bond price of $898.20. So that's the face value of that's the present value of the bond. That's its trading, and the bond has a face value of $1,000. It has a coupon of 10%, and let's say it's got 8 more years left to maturity. How do I solve what the yield to maturity of this, which I can compare obviously with current interest rates, if I wanted to borrow the money to buy the bond? We'll solve, you use a financial calculator to actually calculate this. N years to maturity is 8. FV, the face value, is $1,000. The yearly coupon payments we know is $100. Just simply enter this data, press the I button, and that will give you a yield to maturity of 12.25%. And you can play around with this for different bond prices. Or how do we find the price of a bond? We have all that information. Well, let's find the price of a 10% coupon bond with a face value of $1,000. We know that in this case, a given 12.12% yield to maturity, or we say we will only buy bonds which will actually give that yield to maturity, and 8 years to termination. Again, you enter this data, press the present value button, PV button, and that will give you a price of a bond of $889.20. In other words, this gives you, if that's a yield to maturity you want, that's what the price should be. If it's more than that, it's not worth buying. If it's less than that, it is certainly worth buying. And these are the calculations which bond traders are always looking at. Of course, it gets more complicated because of payments being paid every 6 months and various aspects of risk. We've assumed all these bonds are of equal risk. Well, let's look at another class of coupon bonds known as consols or perpetuity. These are bonds which have no maturity date and which the principal is never repaid, also known as war loans. But they pay a fixed coupon payment forever. In this case, this formula is fairly simple. The price of a console is the value of the yearly interest payment divided by the yield to maturity of the console. This can be rewritten to actually calculate the yield to maturity of the console. The yield to maturity of the console will just simply be C, the yearly interest payment, divided by the actual market price of the console, which of course is the present value of the stream of income. For coupon bonds, this equation gives the current yield as an easy to calculate approximation of the yield to maturity. So if you've got a long bond and you don't want to go through maturing a long time, you don't want to go through the calculations, but if you just want an approximation, if you're just looking at a bond like this in the market, you can use this formula to get a kind of quick approximation of what the yield to maturity would be, or alternative, if you know the yield to maturity, what the price should be. Discount bonds are slightly different, usually short term. A discount bond is one where the yield to maturity depends upon the difference between the price of the bond, which and the face value that the bond is issued at. So let's say you have a bond with a face value of say $1,000. Let's say that's issued in the market without a coupon, but it's a short-term bond, it's issued at the price of $900. Then you can quite quickly calculate the yield by the face value minus the price, $1,000 minus 900 divided by 900, and that will give you the yield to maturity. And most very, very short-term bonds, for example treasury bonds and other bonds, are actually issued as discount bonds. This is why it's quite often called the discount market. The bonds are a discount, and the yield depends upon the difference between the face value and the discounted price which the bond is issued at. So the yield to maturity equals the increase in price over the year divided by the initial price. As with a coupon bond, the yield to maturity is negatively related to the current bond price. Well, what's the distinction between interest rates and rates of return when you're holding financial assets? The rates of return of holding, for example, a bond, is the payments to the owner plus the change in value expressed as a fraction of the purchase price. So in other words, if you're buying a bond at a price now, the price of a particular level, price time t, then the return you will get will be the coupon plus any appreciation in price between the price now and the price in the future, price t plus 1, plus the coupon divided by pt. This will give you the formula for the rate of return. And pt plus 1 minus pt divided by pt is just the rate of capital gain. C over pt is the current yield. C is the coupon payment. Again, pt plus 1 is the price of the bond at time t plus 1. And pt is the price of the bond at time t. Now, of course, the price of the bond at t plus 1 could be less than the price at t. So, if the bond price falls, then the rate of return could actually be negative. So the return equals the yield to maturity only if the holding period equals the time to maturity, because there'll be no capital gain or loss. Because of the negative relationship, a rise in interest rates will be associated with a fall in bond prices, resulting in a capital loss if the time to maturity is longer than the holding period. The more distant a bond's time to maturity, the greater the size of the percentage price change associated with an interest change. In other words, an interest change would actually lead to a larger percentage change in the price, which could lead to a greater capital gain or capital loss. The more distant a bond's maturity, the lower the rate of return occurs as a result of an increase in interest rate. Even if a bond has a substantial interest rate, in other words a coupon rate, its return can be negative if interest rates in the market interest rates actually rise, because the price of the bond will fall and there will be a capital loss which is greater than the return from the coupon rate. And let's look at some differences on the distinction between interest rates and returns. Here we have a very, very simple table. 1 year returns on different maturity of a 10% coupon rate bond. And let's assume that the interest rate rises from 10% to 20%. In other words, it doubles. When you've got different parameters here. We've got years to maturity when the bond is purchased, so it could be 30, in other words, a long period, 20, 10, 5, 2, or just 1. The initial current yield, which is just, of course, the coupon rate divided by the price. It's always 10%. The initial price of the bond on issue, and therefore the face value, when the bond matures, is $1,000. Now let's see how we get the next three columns. The price next year of the bond is just can be calculated. This is PT plus 1, just to, compared to PT, which is, let's say is 1,000. We just get it from the formula that we discussed above, so you can plug it into the calculator by changing the interest rate. This will then give different prices for the bond. As you see, as the interest rate rises, the longer the period to maturity, the lower the price of the bond. The lower the price of the bond, obviously the bigger the capital loss that you will actually get. And the rate of return from holding the bond is simply going to be the coupon that you hold, again discounted, plus the capital loss. So holding a very long-term bond, 30 years to maturity, if you paid $1,000 for it, the price next year will only be worth $503 if the interest rate rises from 10 to 20%, and the rate of return will be minus 39.7% because of a big capital loss of 49%. On the other hand, a bond with only one more year to maturity, current yield is 10%. You paid $1,000 for it. The price next year will simply be $1,000, even if the interest rate doubles. So the rate of capital gain is 0. There's no change in the price, and the rate of return is just simply the discounted coupon rate, which is 10%. Well, what have we learned from that? One, the terms to maturity is related to the volatility of bond returns because of interest rate risk. Prices and returns from bonds, as we saw, for longer term bonds are more volatile than those for shorter term bonds. There is simply no interest rate risk for any bond whose time to maturity is exactly the same as the holding period. The longer the time to maturity from the period of holding the bond, the more chance it is that the interest rate may change, and the more chance that the price of the bond will change, either up or down, which means that the returns for the holding of bonds, the two components of the return, the price component could become positive or negative, so the return could actually become much more positive or negative, and it's obviously much more volatile. So if it's more volatile, it means that there is a substantial interest rate risk. Let's look at the important distinction now between real and nominal interest rates, because obviously holding a bond to maturity, there's a question of inflation. Inflation reduces, as we saw, the value of money, so it reduces at the same time that a dollar in the future isn't worth the same as a dollar today. A dollar in the future could be even more reduced because of expected inflation. So the nominal interest rate makes no allowance for any inflation. The real interest rate, however, is adjusted for changes in the price level, so it more accurately reflects the cost of borrowing. Now, in periods of low inflation, there's not much difference between the two, but in periods of high inflation, obviously interest rates will be going up to adjust for the cost of prices going up. Ex ante, before the event, real interest rate is adjusted for expected changes in the price level. And the ex post, the real interest rate, is adjusted for actual changes which have occurred in the price level. The Fisher equation, again named after Irving Fisher, argued that what is really important is the real interest rate, and that the nominal interest rate at any time is equal to the real interest rate plus investors and economic agents' um, expectations of the inflation rate. If the inflation rate is expected to rise, then the nominal interest rate will rise to compensate above the real rate of interest. When the real interest rate is low, there are greater incentives to borrow and fewer incentives to lend, because you get less back on the value of the money you've lent. So the real interest rate is a better economic indicator of the incentives to borrow and lend. As I mentioned, periods of low inflation, the real interest rate and nominal interest rate may be very more or less the same. Periods of high inflation, they differ. Of course, there is the possibility of deflation. In this case, even if prices are falling, even if the real rate of interest is zero, you may actually, or negative, you may actually find that interest rates will actually not reflect what is actually happening. But we'll talk about that more in quantitative easing and monetary policy. Here's just an example. The real and nominal interest rates, 3-month Treasury bills over the period 1953 to 2014. The nominal rate is in blue. The estimated real rate is a nominal rate minus the rate of expected inflation, or the rate of actual inflation, depending upon which you want to look at. And you can see that as inflation rose in the 70s, nominal interest rates rose, even though real interest rates were actually declining. And real interest rates have been declining in the period since the financial crisis, well below nominal interest rates, although they're still not incentivizing people to borrow or banks to lend particularly. Obviously, there are also index-linked bonds, which actually where the return and the eventual final value is adjusted for changes in the inflation rate. Well, let's look at the behaviour of interest rates. Why are we interested? Well, obviously, monetary policy, as we know, works primarily by manipulating interest rates. Interest rates in markets are determined, in the bond market particularly, by the demand and supply for bonds. Short-term interest rates are determined because of changes in the money market. In other words, much more susceptible to changes in liquidity caused by monetary policy. Interest rate changes will change because of shifts in the demand and supply for bonds. But we also know that monetary policy, if it affects interest rates can have a major impact on the valuation of bonds and on the rates of return to holders of bonds. Well, let's look at some information history on selected US bonds over the period 1950 to 2015. And we've selected 3. The green is corporate BAA. BAA is just the rating agency rating of the relative risk of that bond. 10-year Treasury is government bonds, so obviously the risk is related to the risk of the US government, which is fairly low. And 3-month Treasury bills, again the risk is related to the underlying risk of the US government, which is low, but also the risk is less because of the maturity. We've said that the longer period to maturity, the more a chance of interest rate changes will change the value of a bond in returns. Therefore, obviously, this is much shorter in 3-month bills. Certain things to look at of interest. 1, interest rates start to rise in the 60s and 70s, peaking This is nominal interest rates. Which, this is a period of high inflation. Again, you see the implications of the Fisher equation working here, where nominal rates are the real interest rate plus the rate of expected inflation. Falling down again from the 80s as expected inflation and actual inflation starts to fall. Another thing we see that generally corporate bonds are more risky, as I mentioned, than 10-year Treasury. But we should also look, by way of interest, in the relationship between 10-year Treasury and 3-month Treasury bills, because the only thing which differs here is maturity. The underlying risk of the issuer, the US government, is the same. So we have some periods where the yield curve, in other words, the difference between short and long-term bonds, is quite large. Other periods, as in 2008, 2008, where it's actually more or less the same, then it starts to fall again. And from 2011 onwards, the rate of interest, the rate of interest on 3-month Treasury bills is extremely low, and the rate of interest on corporate bonds on 10-year bonds is actually falling. Well, let's look at what determines these, because as we know, the interest rate will have an impact on the price of bonds. It's negative related, which will have an impact on the returns from actually holding bonds. Well, let's look at 3 perspectives on the bond market, what determines the price of bonds and the interest rate. Well, let's look at bonds basically as financial assets, look at a theory of asset demand in portfolios and asset allocation across portfolios. So let's look at the supply and demand for bonds as part of investors' portfolio. There's a loanable funds perspective, supply and demand for loanable funds in the market, in other words, savings and investment. Demand for loanable funds is demand for investment. The supply of loanable funds is the savings related supply. Bond demand is one of the components of the aggregate supply of loanable funds. But this brings the question, what's actually being traded? Is it bonds or is it the use of funds which is being traded? And then liquidity preference from the Keynesian perspective, which sees speculative demand for money, sees bonds, holding bonds, as an alternative to holding money as a short-term financial asset. Remember in Keynes we had the transaction precautionary, which are based on the Cambridge money balances theory, but Keynes added to this the speculative demand for money, which is called liquidity preference. Well, let's look at first as bonds as financial assets. What are the demand for financial assets? Well, one important factor is wealth, the total resources owned by the individual, including all assets. An individual with very little wealth will not be buying many bonds. The expected return, the return expected over the next period on one asset, such as bonds, relative to alternative assets such as shares, investment in real estate, investment in land, and so on. Risk, what's the degree of uncertainty associated with the return of one asset? Again, bonds relative to the return of alternative assets. Liquidity, the ease and speed with which an asset can be turned into cash relative to alternative assets. Obviously, real estate or agricultural land is not very liquid. Bonds are fairly liquid, although you may have to accept losses, and shares, of course, are fairly liquid as well. So liquidity depends upon the speed and how easy, in terms of transaction costs, that you can convert one asset to cash if necessary. These all affect the demand for bonds as a financial asset. While holding all the other factors constant, ceteris paribus, the demand for an asset such as a bond would be positively related to wealth, more demand for bonds. Positively related to its expected return relative to other assets. The more the return on bonds will rise, the more the demand for bonds should rise. Negatively related to the risk of its returns relative to alternative assets. If bonds look a lot more risky, then that will have a negative effect on the demand for bonds. And positively related to its liquidity relative to alternative assets. Bonds are fairly liquid and convert into cash reasonably quickly. That will have a positive impact on the demand for bonds. Again, this is bonds which are tradable. Bonds which are not tradable may be very, very different in terms of their liquidity. Well, let's consider the demand supply curves for bonds. Bonds, as we know, are financial assets which are either listed in, well, tradable in markets close to listed markets, although the prices are very rarely put in the financial press, as you have with share prices. But traders know the price of bonds which they should be looking at through their terminals. Now, bonds again can be corporate bonds or government bonds, or even municipal bonds, which are issued by local authorities. Well, what determines the demand supply? Well, at lower prices of a bond, in other words, higher interest rates because of the inverse relationship, ceteris paribus, all things being equal, the quantity demanded of bonds from lenders, people are going to lend money to the government or the corporation, will be higher. So there's an inverse relationship. High interest rates, again, because you get income, but it also means low bond prices, will mean there'll be a higher demand for bonds. At lower prices, in other words, higher interest rates, what happens to the supply side? Ceteris paribus, again, all things being equal. The quantity supplied of a bond by borrowers would be lower, so there's a positive relationship. At a high rate of interest, you want to supply less bonds because you have to pay more on it, but as we know, the price is inversely related to the rate of interest, so you'll have a positive relationship. Lower prices, less will be supplied. Higher prices, in other words, lower interest rates, more will be supplied because you actually will be paying less back to your the people who will lend you money through the bond market. Let's look at just a graphical example of this. On the horizontal axis, we have the quantity of bonds, that's in billions of dollars. We have the price of bonds, let's say ranging from $1,000 per bond. And let's say that at $1,000, this is effectively the same as a 0% rate of interest. As the rate of interest rises, the price of the bond falls, as we know, because of the inverse relationship. So if the rate of interest rises to 33%, you see that the bond price will have fallen to $750. At $950, a bond price representing the rate of interest of 5.3% because of the inverse relationship. At this point, the demand for bonds would be at point A. However, the supply of bonds would be at point I. So at this point, you have an excess supply of bonds. People want to lend money more than people want to borrow money more than people want to actually lend money to corporations and governments. If we take the case of a bond price of 750, so very, very high rate of interest, 33%, we have the opposite situation. The demand for bonds is actually higher, but the supply of bonds is actually lower. At a high rate of interest, low price of bonds, the demand for bonds by people who want to lend money will be fairly high because they get a high rate of interest. On the other hand, the interest which we paid by governments, corporations, and so on will be fairly high, so they would want to borrow less money from the bond markets at this price. And like any market, if you have excess supply, the bond price will fall. There'll be downward pressure on price. With excess demand, the bond price would actually rise. So there'll be upward pressure on price, in other words, downward pressure on the rate of interest. And of course, you will have an equilibrium where at this particular point, the demand for bonds is equal to supply of bonds at a price of 850 or a rate of interest of 17.6%. And this would be an equilibrium quantity of bonds supplied and demanded of around about 300 billion based on this graph. Now again, price moves around quite a lot more in market financial assets than it does, say, for example, in the labour market. So this type of market clearing mechanism would happen fairly quickly. And this example here is just for a 1-year zero coupon bond, and that gives you the differences between the rate of interest and the prices. Market equilibrium occurs when obviously the quantity that people are willing to buy of bonds equals the quantity of bonds that people or corporations or governments are willing to sell at a given price. And where the demand for bonds equals the supply of bonds, as in any market, this is the equilibrium or market clearing price and implicitly the market clearing interest rate. When the demand for bonds is greater than the supply of bonds, as we saw, excess demand, investors will bid up the price and interest rates will fall. If the demand for bonds is less than the supply of bonds, there's excess supply, sellers will lower the price and of course the interest rate will rise. What factors determine shifts in the demand curve? Like all our markets, we have our equilibrium, we have our demand supply factors which are related to the rate of interest and the price of bonds, but you can actually have shifts when ceteris paribus isn't held as an assumption. In other words, when all things aren't equal, when there's some change. Well, the demand curve can shift because of wealth and savings. As the economy grows, income and wealth will increase. The demand for bonds would go up, and this would shift the demand for bond curves out to the right, as possibly with all other financial assets, but in this stage we're just looking at the demand for bonds. As the economy contracts, income and wealth would fall, savings would actually fall, and the demand for bonds would go down, which would shift the demand for bonds curve inwards to the left. Expected return on bonds would actually have an impact on the demand curve. If the rate of interest is expected to fall in the future, the expected return for long-term bonds would actually rise, because if interest rate expected to fall, this means that the price of bonds would be expected to rise. Therefore, the return, which remember includes the what you're getting from any coupon plus any capital appreciation, this would be expected to rise. So the demand for bonds would then shift outwards to the right, showing an increase in demand at any price. On the other hand, if the rate of interest is expected to rise in the future, this would mean that the price of bonds is expected to fall. Therefore, the capital gains aspect of the rate of return would be negative. So the return for long-term bonds would actually then decrease. And the impact here would be the demand for bonds would shift into the left at all prices, which is equivalent to a decrease in demand. Third factor, the expected return on other assets. Obviously, people are looking at wealth and returns on all potential financial and non-financial assets. As the expected return on another asset would increase relative to the return for long-term bonds, bonds would become less attractive and you might invest more money in equities or real estate. If the and this would lead to a shift to the left or decrease in demand at all prices for the of the bond curve. Finally, risk. If the risk of the bonds falls, in other words, they look more safe, then the demand for bonds would actually rise. So the demand for bonds shifts outwards to the right. If the risk of other assets actually rises, then the demand for bonds will actually rise, and the bond curve would again shift out to the right. So in other words, either the risk of bonds themselves falls, or the relative risk of bonds compared to other financial rises. The risk of other assets rises, which means that the relative risk of bonds falls. Therefore, this will lead to an increase in the demand for bonds. Liquidity. Liquidity is the ease of turning an asset into cash, either a financial asset or a tangible asset, like property. The more liquid a bond is, in other words, the easier it is to transact. If it's a bond which is a private bond and you have to find somebody else to sell it to, it's not very liquid. If it's traded on a market with transparent price on bond dealers' terminals, then again it's fairly liquid. This would mean that as the liquidity of the bonds goes up, this makes the demand for bonds go up because it's more attractive. Again, the demand for bond curve shifts out to the right. If the liquidity of other assets goes down relative to bonds, then the demand for bonds again would shift upwards, and again the bond curve would shift out to the right. And here's what shifts in the demand for curve for bond looks like. Quantity of bonds on the horizontal axis, price of bonds, or the inverse being the rate of interest on the vertical axis. We have a initial demand for bond curves. Again, we were talking about 1 year bond initially. Any factors which actually lead to an increase that we discussed would shift the demand for the bond curve rightwards, so the demand for bonds will be higher at any particular price level. The factors which shift it inwards would lead to a fall in demand for bonds at any price level. What determines shifts in the supply of bonds? We've talked about the demand. We know that obviously demand and supply determine the price of bonds and the interest rate in equilibrium. That's the interest rate on say 1 year bonds or 5 year bonds and so on. What would determine the shift in the supply of bonds? What would cause one? Well, one, the expected profitability of investment opportunities. In a business cycle expansion, the supply of bonds will tend to increase because more and more companies are borrowing money, as possibly the government. Conversely, in a recession, when there are fewer expected profitable investment opportunities, the supply of bonds will actually fall. Expected inflation. An increase in expected inflation causes the supply of bonds to actually increase. Government activities. Higher government deficits increases the supply of bonds, obviously because the government is borrowing more. Conversely, government surpluses decrease the supply of bonds because the government doesn't need to borrow as much and is actually repaying debt or letting debt retire as it comes due to maturity. And here's what it looks like graphically. Shift in supply of bonds. Again, quantity of bonds, horizontal axis, price of bond, vertical axis, initial supply function for bonds. If there's an increase in the supply of bonds, it shifts the bond supply curve rightwards, so the supply of bonds at any particular price level is higher. Factors which actually shift it inwards means that the demand and the supply of bonds would be lower at any particular price level. Let's look at some case studies, what would happen in theory, and then see what has actually happened in practice. So let's say what's the response in the bond market changes to an expected increase in the rate of inflation. So let's say investors suddenly expect the rate of inflation to actually increase. Well, this expectation would lead to a shift inwards in the demand for bond curves. That's the first step. The second step would be an increase in the supply of bonds, because they would expect, if the demand for bond curves shifts inwards because of the rise in inflation, the rise in inflation also would expect a rise in the actual price of bonds at any particular price. So the supply of bond curve shifts outwards. So we actually have a change. We have a initial equilibrium at BD1 with the equal, so that's a particular price level for bonds, and again a particular interest rate. Then we have a shift in the demand curve inwards, and at the same time a shift in the supply of bond curves outwards. So we move to a new equilibrium. At the new equilibrium, the price of bonds has fallen from P1 to P2, which means that the equilibrium rate of interest has risen because of the inverse relationship. Let's see what's actually happened over time. Here's expected inflation interest rates based on 3-month Treasury bills in the United States, 1953 to 2011. The red line is expected inflation, the blue line is the interest rate. And we see that generally, as the expected inflation increases, then so the interest rate moves upwards, more or less in line, apart from some brief periods. This, of course, you see this from the demand supply for bonds, but of course you'd expect it through the Fisher equation. This is the business cycle and interest rate, 3-month Treasury bills, 1951 to 2008. Again, the interest rate and recessions. We see that the interest rate would tend to actually fall in recessions, although of course in the 70s, although it is falling as you go into recession, it's still relatively higher compared to long-term average because of this inflationary expectations effect that we discussed. The inflationary expectations effect after the financial crisis effectively goes virtually zero or negative, which is another reason why the interest rate falls. How does it work in terms of the bond market? Let's take the first step. Let's talk about not a recession but an expansion. We've got the supply of bonds, BS1. We've got the demand for bonds, BD1. We have an equilibrium at P, where supply and demand are equal at 1. Let's say there's sudden expansion in the business cycle. So more and more firms are wanting to borrow money. The economy is expanding. This will lead to an expansion outwards in the supply curve for bonds to BDS2. This leads to a new equilibrium too, because the demand for bonds also increases. But at point 2, what's actually happened? The price of bonds has fallen because of the shifts in the demand supply curves, but the rate of interest has actually risen. Another way you could see this is in terms of the demand for funds, means that the rate of interest, the price of borrowing money, has gone up, and the price of bonds has actually fallen. In this slide, we consider another aspect, which is the probability of default. So let's look at the prices of Brazilian government and US Treasury bonds from July 1998 to October 1998 to October 1998, including the event, which is the Russian default. See what happens in this case. This is an index of prices of a number of bonds by US Treasury bonds and US government, Brazilian government debt. You can see after the Russian default, there's a significant fall in the price of Brazilian bonds, government bonds. As a result, there will be an increase in the yield on these bonds. In other words, the actual the premium which investors are looking for because of the risk of default. On the other hand, what was perceived as higher quality US Treasury bonds prices actually increase. So in other words, the actual yields actually fall. We can look at the market for bonds from the perspective of a loanable funds approach. In this case, the demand for bonds is just simply the supply of loanable funds, and the supply of bonds is the demand for loanable funds. It's the demand by governments and corporations to actually borrow money, and the demand for bonds is the investors who wish to actually invest money of a return, and this creates a supply of loanable funds. In this case, we're looking at the interest rate rather than the price as the equilibrium, although of course the two are related, and you will then have a normal case of a market equilibrium. Another framework is to use the Keynesian liquidity preference framework proposed by Keynes from the perspective of his theory of how money markets operate. The simplest model is to assume there's just two assets which investors can hold their wealth in, either bonds or money. So total wealth is the composition of both. From the supply side, the money supply and the supply of bonds is total wealth, and from the demand side, the demand for bonds and the demand for money as another way of looking at total wealth. We can put this into an equation, and then rearranging it, you actually see that the money supply minus the money's demand must equal the demand for bonds minus the supply of bonds, again because there's only two financial assets. If the money market is in equilibrium, demand equals the supply of money, then this means that the bond market must also be in equilibrium. How is the Keynesian demand liquidity preference curve derived? Derivation of the demand curve: as the interest rate rises, the opportunity cost of holding money rises. Therefore, the demand for money would actually fall as one of the ways to hold your financial wealth. This gives the demand curve for money the usual downward slope with respect to the interest rate. Supply of curve. The simplest model is to assume that the central bank controls the money supply as a fixed amount, which means that the money supply curve is effectively a vertical line. And the market equilibrium occurs when the demand for money equals the supply of money. And here is a graph showing market equilibrium. Market equilibrium occurs at point C, where the demand for money equals the supply of money, at a rate of interest of 15%. If there's excess supply of money, this pushes the interest rate down. If supply is greater than demand for money. If, on the other hand, there's excess demand for money, demand is greater than supply, this would tend to push the interest rate up, and the movements would eventually lead to an equilibrium. So the equilibrium quantity of money demand equals money supply, at an equilibrium interest rate of I star. If I is greater than I star, money supply is greater than money demand, excess supply of money. Central bank supply of money is greater than the amount of money people are willing to hold. This would push up the price of bonds and push the rate of interest down back to I star. Alternatively, if I is less than I star, this means that the demand for money is greater than the money supply. Given an excess demand for money, this pushes the price of bonds down, interest rates up, back again to the level of I star. You can have shifts in the demand for money, and there's both income effects and price level effects. Higher level of income causes the demand for money at each interest rate to increase, and the demand curve shifts to the right. A price level effect, a rise in the price level, causes the demand for money at each interest rate to increase, and again a shift in the demand curve right. And this is the impact on equilibrium income of any of these shifts. So if the demand curve shifts to the right, this would push up the equilibrium interest rate, as you can see in this graph. Supply of money can also shift. Supply of money is controlled by the central bank. An increase in the money supply by the Federal Reserve or the Bank of England will shift the supply curve of money to the right. A shift in the supply of money to the right, in other words, an increase in the supply of money, will actually reduce the equilibrium rate of interest. And alternative, this puts up the price of bonds. This depends upon everything else being equal. The liquidity preference framework argues that a increase in supply of money will lower interest rates if other things remain unchanged, the liquidity effect. Others have differed. Milton Friedman has been a great critic of Keynes. He argues that over time, as the economy expands, the income effect will be more important because the demand for money depends on permanent income. So this would actually shift the demand of money to the right, which would then lead to an increase in interest rates. Also, there's a price level effect, a rise in the price level possibly caused by expectations of a rise in inflation, as we see below. This will shift the demand for money to the right again, which would mean that an increase in the supply of money does not reduce the interest rate, it actually increases the interest rate. So what is the final possibilities? Liquidity effect, money supply growth raises the price of bonds, reducing the rate of interest. The income effect reduces the rates of interest initially, leading to a rise in income, leading to a rise in demand for money, which would then push up interest rates. Similarly, a price level effect. Income rise would lead to a rise in the price level, pushing up the demand for money and raising interest rates. The expected inflation effect, money supply increases, price level rises, expectations of future inflation rises, demand for bonds goes down, bond supply goes up, and because of a Fisher effect, the rate of interest will rise. The net effect of all these different possibilities means that the effect of the increase in money growth on interest rates will remain ambiguous and must be looked at as a case-by-case scenario. And here's just some different possible combinations of liquidity effect, income expected effect, price level effects of different time periods, and how this would actually impact on the interest rate. You see, in one case the interest rate goes down and up, another word down and rises again, and in this particular case, it's almost unambiguously causes a rise in the interest rate. Well, let's look at long-term bond yields. In other words, yields of bonds of over 10 years, and this is 1919 to 2008, and we look at several types of bond yields. We look at corporate BAA bond yields, and we look at higher rated, or in effect lower default risk corporate AA bonds. We look at US government bonds, long-term bonds, and we will look at, in green, state and local government municipal bonds. And we can see that they differ over time in terms of the yield. In particular periods, for example, the 1920s, the actual yield on corporate BA bonds increased far in excess of the actual corporate AA bonds. And this, of course, is the greater risk. This is moving into the stock market crash and the depression, greater risk of default and bankruptcy. And you can look at the differences between them and government bonds. And this is the rates of interest in a particular period. Obviously, as we saw in the 70s, rates of interest went up, uh, partly because of the inflation effects. But let's see what's actually happening after the financial crisis. The yield on higher risk, higher probability of default corporate BA bonds has actually risen. The yields on US government long-term bonds has actually fallen. So some of the differentials have increased, and they differ at different time periods. So what is the risk structure of interest rates? Why do interest rates yields, why do they differ as a result of risk? Well, let's take bonds of the same maturity, let's say 1 year government bonds or corporate bonds. They would have different interest rates due to several factors, especially if this is corporate bonds. One, default risk. The default risk on US bonds is virtually zero, but the default risk on lower rated bonds is higher. So higher rated bonds have a lower default risk, and therefore companies can borrow money at lower rates of interest being paid. Companies which have a higher default risk will have to actually pay more, so the interest rates on their bonds will be higher, and any change in general default risk, for example, if the bonds rating is downgraded, this would have an upward impact on yields. Liquidity obviously has an impact on interest rates, and tax considerations will have an impact on interest rates. But in this case, we're looking more at this question of default risk. And you've all heard of the term junk bonds, in other words, unrated bonds, which actually have higher yields. Well, what's default risk? It's the probability that the issuer of the bond will be unable or unwilling, because of financial considerations, to make interest payments which are due at particular periods, 6 months or a year, or to eventually pay off the face value of the bond. Well, US Treasury bonds, as we've said, are considered effectively default free because at any time the government can raise taxes to pay or print money. The risk premium is the spread, usually measured in basis points, between the interest rates on bonds with the default risk, because of the chance that they can fail to pay the interest payments of the face value, and the interest rates on, say, maturity treasury bonds. So the risk premium is the difference, the spread between these. And you can look at the spreads between, you can calculate the spreads between US Treasury bonds of any particular periods, let's say 1 year, and the rates of return for, say, of a higher corporate risk security. Let's say that you've got the yield is, say, 2% on 1 year Treasury bonds. A 1 year corporate bond, which is slightly higher default risk, may have a higher risk of, say, may require a high yield of, say, 8%. Well, the risk premium is just the difference between the two. And you actually see these spreads across the Eurozone, where there's actually a difference between very, very low risk German bonds and higher risk Greek, Italian, Spanish, and so on. Again, the risk premium is the spread by holding one bond rather than another bond, and you can compare sovereign debt bonds right across markets. What's the difference between holding Russian bonds to Indian or Argentine bonds, and so on. And let's just see how it works graphically. Let's look at the response to an increase in default risk on a say, a corporate bond. Vertical axis, we have the price of the bond, in other words, the inverse of the interest rate payable. We have, let's say, initially demand C1, equilibrium price PC1 with an equilibrium rate of interest implicitly. If suddenly the perceived risk of these bonds increases, this would have cause a negative shift in the demand. So the demand shifts inwards, the price of the bonds falls. Implicitly, the interest rate rises as the price of the bond falls, and this risk premium is the difference between, in this case, IC2 and IT2. And the risk premium is by comparing the actual interest rate, which is implicit on the fall in the price of bonds, in this case to PC2. That has an implicit interest rate of IC2, the inverse. Compare that with a default-free US Treasury bond of the same maturity. In this case, you have a supply of the Treasury bond. If the demand for the corporate bond shifts inwards because of an increase in default risk, it means the demand for an equivalent maturity bond to get back to the level of risk before means that the shift for that Treasury bond would go outwards, and that would then sell at the price PT2, which has got the implicit interest rate IT2. So again, the risk premium is just the difference between the two. You can see here, this is just some bond ratings by Moody's, Standard & Poor and Fitch. Higher ratings, AAA, round down to B's and C's, and then unrated, and what they actually mean. For example, higher rated prime maximum safety, higher grade high quality, upper medium grade, lower medium grade, non-investment grade, speculative, substantial risk, poor standing, and then maybe in default, and so on. So the rating agencies, the rating of a particular bond, the risk of that bond will have an implication on the price of that bond, and then that have an implication for the interest rate which investors expect the borrower to actually pay. Of course, there's some potential conflict of interest in this market, which we'll look at in more detail, in the sense that the rating agencies are not some government independent body which looks at the risk of default from an objective standpoint. Quite often they're actually paid by the, in fact in most cases they're paid by the issue of the bond, so there's a conflict of interest. Again, the risk structure of interest rates, liquidity affects risk, the relative ease with which an asset can be converted into cash. We'll have to look in this case at the cost of selling bonds and how many buyers and sellers there are in the bond market. If there are not many buyers and sellers, it'd be a very liquid bond which would have a higher risk because of liquidity. Income tax considerations, interest payments on municipal bonds in the United States, for example, are exempt from paying federal income tax. Let's look at interest rates on municipal and treasury bonds. The relationship between them. Let's look at the quantity of municipal bonds, the market for municipal bonds, and the quantity of treasury bonds. Again, you can actually see that there's if the demand for municipal bonds went up, shifted upwards, this would put the price up. In other words, reduce the interest rates changed, and this might have an implication for the demand for treasury bonds if there's a change in the underlying characteristics. Bonds with identical risk, liquidity and tax characteristics may have different interest rates because of the time remained to maturity is different. So again, we've talked about risk, liquidity, tax characteristics may impact the interest rate. If we hold all of these constant, then we still may have different interest rates on the bonds because of the time remained to maturity. So we will compare a 1-year bond with a 10-year bond and so on. The time to maturity is a determinant of a relationship which is called the term structure of interest rates. It tends to be upward sloping generally, and that long-term rates are above shorter term rates. If it's flat, which sometimes occur, means that short and long-term rates are the same. Inverted, which occurs in particular periods and sometimes seen as a warning signal of a coming recession. In this case, long-term rates are below short-term rates. But generally, the normal form of the yield curve, which shows the term structure of interest rates for a plot of the yield on different bonds with different terms of maturity but the same level of risk, liquidity and tax considerations, the yield curve is normally upward sloping. Well, there are a number of empirical observations that any theory of the term structure of interest rates must be able to explain, so that the theory concords with what actually occurs in bond markets. First one is that interest rates on bonds of different maturities do tend to move together over time. Second one is that when short-term interest rates are low, as they are currently, yield curves are more likely to have an upward slope. When short-term interest rates are high, on the other hand, yield curves are more likely to slope downwards and have an inverted shape. Thirdly, generally, apart from the case we've just talked about, yield curves almost always slope upwards. As the term to maturity rises, the rate of interest would actually be higher, the yield on those longer term bonds. Well, there are three theories around which try to explain these three facts. Expectations theory explains the first two facts but not the third. Segmented markets theory explains fact 3 but not the first two facts. And liquidity premium theory combines the two theories to try and explain all three facts. Let's have a look at these theories. First one, the empirical reality that movements over time of interest rates of different maturities tend to move together. And here we have 3-month data from 1950 to 2010. Data on 3-month Treasury bills, average interest rates on 3 to 5 year bonds, and then the interest rate on 20-year longer term bonds, the average on all of these bonds issued. And you see that generally they tend to move together. But of course there are periods, as in the financial crisis, when short-term interest rates plunged quite dramatically. Let's look at expectations theory. According to expectations theory, the interest rate on a long-term bond will equal the average of the short-term interest rates that people expect to occur over the life of the long-term bond. Buyers of bonds do not prefer bonds of one maturity over another. They will not hold any quantity of a bond if its expected return is less than that of another bond with a different maturity. Bondholders consider bonds with different maturities to be almost perfect substitutes. Let's do an example of expectation theory. If you assume the current rate of interest on a 1-year bond is 6%, you would expect the interest rate on a 1-year bond to be 8% next year. Then the expected return for buying the two 1-year bonds would be an average of 7%. So the interest rate on a 2-year bond must be 7% for you to be willing to purchase it, or if it's not that, it won't be purchased. For an investment of $1, IT is today's interest rate on a 1-period bond. IT plus 1, E is the interest rate on a 1-period bond expected for next period, and IT2 is today's interest rate on the 2-period bond. So this you can calculate the expected return over the 2 periods for investing $1 in the 2-period bond and holding it for the 2 periods. Since the expression I QT squared is going to be extremely small, the expected return for holding the 2-period bond is effectively 2I 2T. If 2 1-period bonds are bought with a $1 investment instead, again you can calculate the returns. I, T, I, E, T plus 1 is extremely small, so simplifying we get the following expression. Both bonds will be held only if the expected returns are equal, as we showed in the first example. So the 2-period rate must be equal to the average of the 2 1-period rates. So for bonds with longer term maturities, looking at not just the 1 and 2 years, the nth period interest rate equals the average of the 1-period interest rates expected to occur over the n period life of the bond. So expectations theory explains why the term structure of interest changes at different times. It explains why interest rates on bonds with different maturities will move together over time, which is one of the empirical observations. And it will explain why yield curves tend to slope upwards when short-term rates are low and slope downwards when short-term rates are high. However, it cannot explain why yield curves in most cases usually slope upwards, which is fact 3. Let's look now at another explanation for the term structure of interest rates, segmented markets theory. According to this view, bonds of different maturities are not substitutes in any particular way. So the interest rate for each bond with a different maturity is determined by the demand and supply for that particular bond. And investors have preferences for bonds of one maturity over another. If investors generally prefer bonds with shorter maturities that have less interest rate risk, then this explains why yield curves would usually slope upwards, which is explanation for fact 3. Finally, let's look at the liquidity, premium and preferred habitat theories to explain the term structure of interest rates. The interest rate on a long-term bond will equal an average of short-term interest rates that are expected to occur over the life of the long-term bond, plus some liquidity premium that responds to the supply and demand conditions for that bond. And again, we saw earlier the what determines supply and demand conditions for bonds. This means that bonds of different maturities are partial but not perfect substitutes. And the liquidity premium for an n period bond at time t is then just an average of the expected yields on the bonds at t plus 1, t plus 2, okay, t minus n minus 1, and then the final liquidity premium, which is always positive, and this rises with maturity, with the term to maturity. What's the preferred habitat theory? This is that investors have a preference for bonds of one maturity over another. For example, pension funds, insurance companies would always have a preference for longer term government securities or corporate securities. Other investors, for example, banks which need more liquidity, may invest in shorter term securities. So investors will be willing to buy bonds of different maturities only if they earn a somewhat higher expected return than what their normal preferences would dictate. So in other words, a bank who wants a shorter term bond will only move up to buy a longer term bond if the expected return is high enough. So they need a higher expected return. But generally, most investors, apart from the longer term investors we talk about, are likely to prefer shorter term bonds over longer term bonds. So this shows you the interest rate on the vertical axis. The expectation theory would give us more or less a horizontal yield curve. And the shape that we normally see, the term structure of interest rates, is based upon this idea that there's a preferred habitat, but a liquidity premium is required as the term to maturity increases. Interest rates on different maturity bonds would then tend to move together. This is explained by the first term in the equation. And yield curves tend to slope upwards when short-term rates are low and inverted when short-term rates are high. That as well is explained by the liquidity premium term in the first case and by a low expected average in the second case. But generally it explains the fact that yield curves typically slope upwards. This is explained by a larger liquidity premium which is needed as the term to maturity lengthens, as we saw in the previous graph. Putting them together, we can look at certain ideas about the term structure. Again, on each of these graphs we have the yield to maturity in the vertical axis, term to maturity on the horizontal. So let's say if future short-term interest rates are expected to rise, this would lead to a steeply upward sloping term structure. If future short-term interest rates are expected to more or less the same, this will lead to this more moderately sloped term structure, showing the normal shape. If future short-term interest rates are expected to fall, this would produce a horizontal term structure, and if future short-term interest rates are expected to fall sharply, this could lead to an inverted term structure. For example, if a recession is expected, you would then expect that the government would actually increase the money supply quite significantly, and this is why an inverted yield curve is quite often seen as a harbinger of a future coming recession. Finally, we'll just show a graph of a kind of normal term structure of interest rates, a yield curve for United Kingdom government securities or gilts in 2012. And this shows a kind of fairly normally well-behaved yield curve. At this particular point, and it's shown difference between several weeks. The blue line is the yield curve as of 5th of July. Obviously, the yield curve changes day to day, week to week, and then it shows it again in the 1st of August, a couple of weeks later. So the yield curve at any particular moment in time, for this case, is between 0 and 5 years. It's around about 2%, rising up to about just over 4% for bonds, government bonds with a maturity approaching 25 years. Thank you very much. Thanks.